Hello, it's been a while. Today we have a fascinating topic to dive into. It's about the book Bear Market Investing Strategies, something that I think is really fitting in these times. Now, I've been reading this book and I wanted to share with you some of my key takeaways that I think can help you navigate the ups and downs of the financial markets. So to start things off, let's talk about what a bear market is and why it's often considered an investor's worst nightmare. So imagine this, stock prices plummet, economic uncertainty is at its peak, and panic seems to rule the day. In a bear market, everyone is running for the hills. But did you know that some of the most successful investors believe this is when real wealth is actually created? The book breaks down a market cycle into 5 distinct stages, and each one plays a crucial role in shaping your investment strategy. It starts with a disruption phase, where changes like technological advancements such as AI or internet technology or fundamental economic shifts begins to shake things up. From there, we move into the bull market, where some recognize the potential and start investing. This is then followed by the bubble phase, which is marked by the irrational exuberance and speculations driving prices to its peak. And here's where it gets interesting. The bubble eventually bursts in an external shock phase, leading to widespread negative sentiment. But it's in the disgust phase that truly defines a bear market. That's when media starts using words like worst crisis and the lowest point in history, and everyone starts thinking the system is rigged against the little guy. People usually focus on what the external shock is, not actually preparing for when it comes. The truth of the matter is we almost never know what the external shock will be that triggers the bursting of the bubble. Now, let's move into some strategies. The book focuses on stages 3 to 5, which are often the most trickiest to navigate. First, the book stresses the importance of emotional control. In a bull market, you want to maximize good decisions, but in a bear market, you need to minimize the bad ones. So what can you do to minimize your bad decisions? There are a few strategies. First is the blood in the streets problem. Avoid jumping in when everything is falling. Wait for great opportunities. Appreciate a crisis. Think rationally when others are panicking. Stop chasing momentum. Avoid overreacting to market news. Focus on the long term. Short-term success isn't as crucial as long-term stability. Evaluate your portfolio. Ensure your capital is allocated optimally. Avoid narrative investing. Don't get caught up in market narratives. When it comes to analyzing information, the book emphasizes the need to start at the core, like the layers of an onion. Begin with the SEC filings, particularly the 10Ks. The 10Qs can be used, but seeing as they're not audited in the same way, they're not as useful. 10Ks is where the truth really lies. And look for key sections like the business overview and the risk factors. The layer after the 10K filings are the press releases from the company. After this, you have the earning calls. Then you have the analyst reports. And then the fifth outer layer is mainstream news, social media, and tips from friends and family. Remember, the further away you go from the core, the less reliable is the information. So try to stay with the 10K filings and go out from there. I'm a bit disappointed by this part. I really wanted some numbers here, but there really wasn't much. Another good strategy is to hedge and diversify your investment. Consider precious metals like gold. Gold is often seen as a hedge against inflation, and prices often move based on fear. Think about short selling. Invest in bonds and treasury bills. Another advanced strategy is options. These are financial instruments derived from underlying assets like stocks. They come in the form of calls and puts, allowing you to buy or sell an asset at a specific price and time. Two option strategies are mentioned in the book: protective puts and cash reserved puts. The former helps limit downside risks, while the latter allows you to bet on stock price increases without actually owning the stock itself. I think it might actually be worth for you to read further on these subjects. I don't really have the skills to explain these in sufficient detail, so just Google their names. And there you have it. That's my summary of bear market investing strategies. It's all about navigating the tumultuous world of bear markets with a rational and well-informed approach. And remember, it's not about avoiding the bear markets, but actually thriving within them. And in order to thrive, you need knowledge and a well-thought-out strategy. And this can be done by controlling your emotions, diving into the core of the information, the 10 Ks, diversify, and consider options to hedge. Be ready for opportunities when everyone else is in panic mode. I hope you found this video helpful, and thank you for listening.